we are in conversation. In fact, Harsh is in conversation with Bernstein on their outlook for the banking sector. So let's quickly go across and hear out that.
We've spoken about ICICI. You just spoke about them. Let me try and cover that too. Just with regard to that being a better bet, given the current circumstances, risk reward, of course, less favorable, it seems, at least from a relative valuation perspective. But therefore, is ICICI a better bet?
Yeah, I think ICICI will continue delivering its healthy compounding story. I think the reward, though, is limited to that compounding improvement. The chances of a multiple re-rating looks less in the case of ICICI. Now, there are two potential scenarios which could drive a higher multiple. One is an asset quality situation or deterioration across the board, and ICICI coming out on par with an HDFC or Kotak in terms of its asset quality. That will then demand a premium that HDFC and Kotak used to earn in the past. That is one scenario. The other scenario is where the bank delivers a higher deposit growth than HDFC. Now, despite all the concerns around HDFC's loan growth and profitability, their deposit growth continues to be on par or even superior to ICICI in most of the recent years. A change in that trend will probably strengthen the case for ICICI's premium to become permanent. So barring these two scenarios, it's hard to see a big premium set in permanently for ICICI beyond where it is already trading in today.
Sure. And, let me also go to the other largest consumer lender. When Bajaj Finance is concerned, that's been the other underperformer outside of HDFC in the financials. What's your sense? What's happening there? What's the key concern? And is there a turnaround possible there with regard to investor returns and fortunes?
See, I think Bajaj is probably a few steps behind HDFC in this whole turnaround story, if you want to call it that. Because there, I think the concern is more around the durability of growth at the current high ROA numbers, right? So I think the lender is at 4.6 to 4.8% ROA. I think the concern there is, can they continue growing at 25, 27% while maintaining that profitability? We think it would be difficult. And therefore, there has to be a reset of expectations, either in terms of growth or profitability. And then once you have a reset, then they could get back to their usual trajectory of beating expectations. Until then, I think it's going to be a bit of a trouble for them. And I think there are also other overhangs that exist for the stock. I think there is a management transition which is around the corner. There is the listing of its subsidiary BHFL. And also there's been a foray into various new segments. And the lenders' initial success factors or success metrics in those new segments will also remain a bit of an overhang. So I think all those three are temporary or near-term overhangs. And the longer-term issue would be around what is the sustainable growth and profitability combination that the lender could deliver. I think once that new normal is set, then we could get back to that healthy compounding story that it is so delivered in the last decade or so.
Sure, you've basically ascribed it a valuation of 25 times earnings forward, 24 times earnings. Give us the rationale behind why a P ratio over a PB ratio for something like a Bajaj Finance.
See, I think historically, many of the fast-growing lenders have been valued using price to earnings, simply because they come back to the markets for capital so frequently that the book value and the capital ratios, and therefore the book value tends to be quite volatile, right? So your price to book tends to drop immediately following a capital raise and then build up again, only to drop again when there is a big capital raise. So to avoid that seesaw change in price to book multiples, investors have typically used price to earnings. And Bajaj is one of those stocks which has held up well to the PG of one thumb rule, where their long-term earnings growth has been roughly about 35% CAGR. And it's also traded somewhere in that range from a PE multiple perspective. So our rationale is that this is a lender that is going to settle in at low to mid 20s earnings growth. And therefore, the PE multiple would also settle at something similar. And therefore, our rationale for that 24 times price to earnings for Bajaj.
Okay. With regard to the corporate credit cycle, because we've been talking so much about it over the last few quarters, really not kicking through. When do you expect that to happen? And which lenders would you have your eyes out on when it comes to corporate capex?
I think it's been a long wait. I think we had the first glimpses of it last quarter when the public sector banks showed a reasonably healthy pickup in corporate credit growth. The likes of an SBI, for example, saw mid-teens growth in the corporate segment. So it does seem to be around the corner. We've had quite a few false starts. So I don't think it's there in anybody's base case today in terms of the loan growth projections, etc. But we do expect it to come back and drive the next leg of growth for the segment. Now, who would benefit? I would say the private sector banks this time are better positioned to capture the opportunity simply because they have better capital ratios, larger equity bases, better deposit growth even. I think the excess liquidity for the public sector banks are largely consumed. So the liquidity factor comes down to deposit growth, where the private sector banks are doing much better than the public sector banks. And finally, they've also captured a lot of the float and flows, which in our view is key to underwriting well in this segment. And therefore, the private sector banks are indeed better positioned. I think where it becomes a bit of a question mark is their willingness to lend. So right now, we are seeing the public sector banks a bit more keen to lend into this segment versus the private sector banks. Part of that could just be the the memories of the troubled phase that they went through during the last cycle. And the other is also the fact that the retail segment continues to grow at a reasonable pace. So I think a slower retail credit growth, or at least reduction in the risk-adjusted yields on the retail side, or reduction in the gap between the retail and corporate side in terms of the risk-adjusted yields, would drive the interest for the private sector banks back towards the corporate segment. So from a pure ingredients perspective, the private sector banks are better positioned. Their willingness is lower now, but at the right yields, I do think the private sector banks will come back into this segment, and they will benefit, especially the large 2 or 3 banks will benefit from a revival in the corporate credit.
Right. And just with regard to loan to deposit, you're seeing private sector banks loan to deposit ratios far more efficient, closer to the 90 to 100% kind of mark, HDFC at 105, of course, versus the PSUs. Do you believe that will not play a role with regard to, taking advantage of the corporate capex cycle? So wouldn't it therefore advantage PSUs over private banks? Just trying to get that perspective.
Right. See, I think a lot of the lower loan to deposit ratio for the public sector banks is structural, meaning that they have lesser equity and therefore they need to hold more deposits. I mean, imagine you have $100 to fund on the asset side. If you only have $10 of equity, you need to hold $90 of deposits. Whereas the private sector banks, if they have $20 of equity to fund the same $100 of assets, they can do with $80 of deposits. So a lower loan to deposit ratio, therefore, to a large extent is structural for the public sector banks. And it can converge with the private sector banks only when their capital ratios are on par or is in line with the private sector banks, at which point their ROEs will drop quite significantly. Because today, the higher ROEs for the public sector banks is largely a result of greater leverage. So if they raise more equity, then that ROE will take a knock as well. So there's no easy excess liquidity available for the public sector banks for them to dip into, which is also visible when you look at the pricing of term deposits today, because the public sector banks are actually paying a higher price, almost about 30 to 40 basis points at an aggregate level for term deposits compared to the private sector banks, which is an inverse of the trend that you've seen during most of the last decade, where the public sector banks have generally tended to pay a lower price compared to the private sector banks when it comes to term deposits. So there is liquidity pressure through the system. There is no special advantage, or whatever special advantage in terms of excess liquidity that the public sector banks had has largely been consumed. So both the segments, both the both the sets are largely on par today from a liquidity perspective.